Good morning, everyone. Welcome to the third virtual session of Prime Time, and today's session is Markets in a Pandemic. I'm Tom Jasper, your moderator, and the two people you see on your screen are Huey Evans and Blythe Masters, our two speakers for today. Their bios speak for themselves. Just quickly, Gay was appointed as chairman of the London Metal Exchange in December 2019. She's an independent non-executive director of Standard Chartered, where she is chair of the board committee on financial crime and serves as a member of the board risk committee. She is also a non-executive director of ConocoPhillips, Bank Itaú, BBA International Limited, and a member of the Her Majesty's Treasury Board. Gay spent several years at the Financial Services Authority and also worked at Citi and Barclays Capital, where she was vice chair of investment banking and investment management, responsible for Barclays' relationships with sovereign funds globally. She was a non-executive director of the London Stock Exchange Group between 2010 and 2013, and Aviva PLC 2011-2015. Gay holds a BA in economics from Bucknell and received an OBE in 2016 for services to financial services and diversity. She is a member of the Chatham House panel of senior advisors, a trustee of Beacon Awards, and of well-being of women. She is a member of the U.S. Council on Foreign Relations and, last but not least, a P.R.I.M.E financial expert. Blythe Masters has extensive experience in banking, capital markets, derivatives, regulation, commodities, and financial technology. She's an industry partner at Motive Partners, the fintech specialized private equity firm. She's a former JP Morgan executive and CEO of Digital Asset, the New York headquartered blockchain fintech company. She's a board member of AP Moeller Maersk and Santander's digital banking platform, Open Digital Services. She's chair of enterprise mobile platform provider Funware. I think I'm pronouncing that correctly, Blythe. Yep. A member of the Brookings Task Force on Financial Stability, vice chair of ID 2020, and again, last but not least, a P.R.I.M.E financial expert. And I'm Tom Jasper. I have been in the derivatives and banking world for many years. I was one of the founders of ISDA, was its first co-chair. Was 18 years at Solomon Brothers, and then set up my own company called which was a credit derivative platform. And currently I serve on the board of a number of companies, including Blackstone and Jenner Resources, a mining company based in Atlanta. So the topic today, as hopefully everybody knows, is how is the pandemic leading to market disruption, valuation, and structural issues? What's the impact on liquidity and trading relationships? Do market disruptions create increased opportunity for financial crimes? Have they revealed financial systemic stability risks? And what are the implications for innovation and technology? So a very exciting topic for today, which I'm very pleased to moderate. Just some housekeeping notes. This session is being recorded and will be distributed later. Attendees who continue to participate will be taken to have consented to such recording. Attendees are muted and have their video turned off. If you have a question, and we hope you will, whether for the panel or a technical nature, please use the Q&A function to get in touch. It can be helpful to include your name and affiliation. Questions for the panel will be answered at the end of the session, and I will moderate that, and hopefully we will have many questions. We will use the chat box to send messages to all attendees during the course of this session. We, of course, want to thank Lexus and Milex for their support of Prime Time and assistance with promotion. And we want to thank Druid Financial Technologies for their sponsorship of this first series of Prime Time. So with that, let me get the session started by giving you sort of a brief overview to sort of set the stage for our speakers. Clearly, as we all know, the coronavirus pandemic has had a significant impact on the markets. And just some perspective, from a macroeconomic impact, certainly monetary policy, central banks have taken very aggressive actions in response to the shutdown of most economies, including massive injections, liquidity, and credit market support, as well as slashing interest rates. In terms of fiscal policy, governments have taken aggressive and unprecedented actions in an attempt to limit the human and economic impact of the pandemic. Even with these very aggressive actions, Deutsche Bank forecasts a 7.1% contraction in the US this year and a larger 12% contraction in the Euro area, with corresponding high unemployment. Central banks have indicated that they're not finished and that they have more tools in their toolkit and will do whatever it takes to help economies manage through the pandemic. In terms of the market impact, just to give you some perspective on the magnitude of the market impact of the pandemic, let me provide you with the raw data from Bloomberg on some key markets. In terms of the oil market, it hit a high of $63 on January 6th, a low of $37 on April 20th, and is currently at $39. The S&P 500 hit a high of 33.86 on February 19th, a low of 22.37 on March 23rd, and is currently at 31.52. The VIX, which is a measure of market volatility, hit a high of 82.69 on March 26th, a low of 12.10 on January 17th, and is currently at 29.26. And the US Treasury 10-year hit a high of 1.9% on December 31st of 19, a low of 54 basis points on March 9th, and is currently at 61 basis points. In terms of, with this raw data in mind, let me provide just a quick overview of how some specific markets have performed during the pandemic. Well, to begin with, and you probably would expect this, sovereign debt and other safe havens such as gold have outperformed risk assets year-to-date 2020. At July 7th, the S&P 500 has climbed 42% from its depths in March. The Stocks Europe 600 has climbed 33% over the same period. Certainly two indicators that the markets seem to have decoupled from the economies in recent months. More recently, they've turned slightly positive. In US credit markets, investment grade spreads are 52% above their pre-sell-off levels in late February. High yield spreads are 63% up. Leveraged loans up 53% over the same period. Interestingly, in June, there were 61.5 billion of new high yield bonds were issued, which was the most active month on record. And there was a record pace of inflows into high yield mutual funds over the past 12 months. As you probably also would expect, default rates have shown significant increases in June, and but notwithstanding this very strong performance, the high yield and leveraged loan indices are still down for the year. In terms of derivatives, some key points. from a recent ISDA survey of market participants. Number one, in the early stages of the pandemic and country lockdowns, there was a significant decline in liquidity across derivative product sets, particularly non-cleared interest rate swaps. There was also a reduction in the risk appetite of banks, not surprisingly, resulting from the prevalence of one-way flow, increased volatility, and the breakdown of common basis trading strategies, and of course, increased funding costs. Central bank intervention, which took place, which I mentioned, was an important factor in restoring market liquidity. But ISDA points out in their survey that, and in conclusion of the survey, that the derivative markets continue to function even at depths of the crisis, and key infrastructure, including clearinghouses, operated largely without issue. And I've sort of saved a little bit of the best for last here, which is U.S. commercial real estate. It's currently estimated that $500 billion in commercial mortgage-backed securities, or CMBS, are outstanding. CMBS credit spreads have significantly lagged behind investment grade and high yield recoveries, although the AAA tranches have tightened by 60% since their low in late March, at least in part because the AAA tranche is eligible collateral for a Federal Reserve facility. BBB tranches over the same period have recovered approximately 30%, so again lagged significantly from their March lows. And as businesses reopen, the market will gain more clarity on the lasting damage to commercial real estate fundamentals. The market is digesting the forbearance and delinquency data in June. In June, according to Citibank, borrowers were behind nearly 30% of hotel loans and 10% of retail loans. Loan delinquencies have spiked, with overall delinquency rate in April of 2.3%, according to Fitch, but Fitch expects that to climb to around 8.7% by October. Citibank estimates that in June, overall market delinquency rose to 10%, with hotels at 24% and retail 16%. Pension and Investments estimates that CMBS delinquencies rose to $54 billion in June, and multiple CMBS have already been downgraded or placed on credit watch. Real estate portfolios within REITs have been marked down, but not to the level of repricing in the CMBS market. Distressed real estate investors have been focusing on the CMBS securities market, where there has been a significant repricing, because of the significant repricing. The one major law firm has just released a position paper entitled U.S. Outlook, Potential CMBS Litigation Arising from the 2020 Downturn. Clearly, the CMBS market will bear watching over the foreseeable future. It is clear that investors in these markets will continue to pay close attention for the remainder of 2020, at least to the spread of the virus, hotspots, and prospects for a vaccine as they make their investment decisions. And every company is being impacted by the virus, and management will continue to do their best to perform in this environment. Trying to forecast company performance will continue to be extremely difficult. When will the various global economies recover to the 2019 levels, given the impact of the pandemic? At least in the U.S., some analysts indicate third quarter 2021, and many others are indicating 2022. I guess it's safe to say only time will tell. With this brief summary of the overall impact of the pandemic on some key markets, let me now turn to our panelists for their presentation. And let's start with Blythe Masters. Blythe, to you.
Thank you, Tom. It's great to be here, and thanks for that context, which really helps set the scene. I'm going to focus my comments on the question of what all of this has revealed relating to financial stability risks in the global financial system that have been illustrated or emphasized by the activities that you've partly described. And then I'll turn after that just to spend a few minutes at the end on what are the implications, again, of all of this for innovation and technology. So starting with financial stability issues, we all know that the global financial crisis precipitated a raft of new regulation that was oriented towards protecting the world economies from risks arising from financial activities that triggered that crisis back in 07, 08, 09. And some of us were taking the opportunity 10 years on to, in a what we thought initially in a leisurely fashion, review what were the residual risks that had not been addressed through those regulatory reforms, and perhaps some others that have been created or even worsened as a consequence, unintended consequence of those reforms. And a task force was formed by Brookings, along with Chicago Booth that I participate in. And then along came the events in the markets triggered by the COVID pandemic that you described. And I think it's safe to say that what the market action has served to do is to highlight the fact that there are a number of continuing fault lines in financial stability or with financial stability implications that remain unaddressed and have come into, have been highlighted through the recent weeks and months. And when we talk about financial stability, we're really looking for situations where the individual actions of actors within markets may be rational and individually benign, but when taken in the aggregate, there is a sufficient externality arising from those actions that merits an intervention with a view to managing the financial stability implications of that wouldn't be tackled through individual regulation at a micro-prudential or individual entity level. I think probably the most obvious of the market developments that we saw that's relevant to this is what happened as a consequence to the extraordinary flight to US dollar liquidity that we saw across almost every entity, across every market. And in that circumstance, in financially stable markets, you would want the world's deepest, most liquid interest rate markets to be functioning well. But what we actually saw was extraordinary instability and fragility in the performance of US Treasury markets, illustrated by the fact that we saw spreads widen by a factor of 10. We saw market depth decline by a factor of 10. We saw the cash futures basis exploding. We saw significant mispricing or essentially absence of any pricing for off-the-run securities. We saw dislocations in the shape of the yield curve, and so on and so forth. All of this was really brought to a halt only following massive intervention by the Fed, who essentially was forced to become the dealer of last resort, purchasing over $1 trillion of Treasury securities within the first 3 weeks, and they really haven't, ceased those activities, although they've tapered off somewhat. Those activities are ongoing. And that was needed just in order for market participants to be able to convert liquid instruments, the most highly liquid instruments, to cash. In other areas of the markets, turning to money markets and mutual funds, a persistent concern prior to the COVID crisis that has certainly been illustrated as a real concern during the crisis is that many of these funds are owned or invested in as if they are an alternative to cash. And yet the underlying instruments that the funds are themselves invested in, ranging from high quality governments all the way to much lower quality corporate and other assets, don't have the same liquidity characteristics that the underlying funds offer to the investors in the funds themselves. So this is a liquidity mismatch, which doesn't matter unless the size of that mismatch is so significant relative to the size of the ability of the market to absorb liquidation behavior when that liquidation behavior is conducted by everybody simultaneously. And we saw that occur much as we had back in '08 when a bailout was required for the money market funds, despite the fact that in 2016 reforms were executed in the US by the SEC that introduced floating NAVs for prime and institutional funds, fixed for others, that introduced liquidity fees and gating. Nonetheless, what was needed again in this instance was essentially another bailout by the Fed, where the run on those assets didn't end until the Fed essentially stepped in with new facilities for money market mutual funds, liquidity facilities, and commercial paper funding facilities. So the issue there was, again, the mismatch between the underlying liquidity of what funds owned and what investors were relying on in terms of their presumed liquidity characteristics for these instruments. This was also particularly the case in some of the larger corporate bond mutual funds, where you saw significant sell-off in ETF and mutual fund pricing. You saw historically more or less unprecedented widening in credit spreads, and real distress at funds, even amongst the largest and most sophisticated, who routinely carry 5 to 10% in the way of cash liquidity buffers and deploy sophisticated techniques for being able to meet redemptions. Even those most sophisticated of funds were suffering extraordinary outflows and running the risk that they would not be able to meet their investors' obligations. Again, the run really only stopped when the Fed stepped in. Similarly, in the aftermath of '08 and the regulatory reforms that followed from that, it is well understood that a significant amount of the focus of those reforms was on strengthening bank balance sheets, reducing leverage in the banking system, improving liquidity and capital buffers, and modifying certain behaviors, including outlawing of proprietary trading and principal investing and so on. The net result, though, of all of this was that bank balance sheet and dealer balance sheet capacity, in the face of these extraordinary movements in markets, when normally you would expect dealer intermediaries to be able to step in and absorb through the accumulation of inventory, that behavior was essentially constrained. Again, the Fed stepped in to ease situations by relaxing reserve requirements, relaxing capital and liquidity buffer requirements for periods of time. But the reality was that the traditional dealer intermediation role, in part because of the impact of prior regulatory changes, whilst it meant that the dealers and banks were not the source of the problem this time around, they weren't able to essentially intermediate in a way that helped reduce the pressure on markets and enable their customers to exit their positions when needed. If you look at the insurance sector, this is a sector which sold off at least as aggressively as some of the worst hit sectors within the equity markets. And what that is telling you is that the new environment, which could be assumed to be essentially, low to zero to negative interest rates for the foreseeable future, even longer than was previously expected, that it has implications for the integrity of insurance balance sheets and the mismatch between their policy liabilities and the instruments that they invest in on balance sheet to fund those liabilities over time. The insurance sector essentially has mismatches in it that are both a result of the stretch for yield, which has forced them further out the yield curve from a maturity point of view and further down the credit quality spectrum, in search of yield in light of the low interest rate environment is creating stress on those balance sheets that the equity markets priced in very aggressively during all of this. And that is, again, a story which will take time to play out, but is one which will have implications for market behavior if insurers become forced to start liquidating assets. And going on in the background, not always part of the headlines, but an equally important part of the story is the fact that in energy markets we saw a correlated supply and demand shock simultaneously, a massive downturn in consumption because of the reduced global activity, and an increase in supply because of essentially disagreement amongst OPEC members and non-OPEC members around curtailing production, with the result that we, have seen extraordinarily low prices, which, when compounded with the fact that you have pressure from a carbon responsibility point of view, so from climate change activism and the concerns that results in terms of potentially creating stranded assets on both on financial institutions' balance sheets, both lenders and investors. That has created essentially a perfect storm of asset devaluation potential, which again has by no means played out, even though you've already seen material declines in valuations. There has not yet been the kind of forced liquidation that is potentially the source of future market instability. So there are a lot of things that are still playing out that have implications for valuations and for market behavior that we need to stay focused on in the aftermath of what really is only the first of several chapters that has been triggered by this COVID situation. And obviously, bank balance sheet impairment is going to be a big part of that story, which remains, as we speak, hard to predict. You'll have seen some very significant reserving actions taken last quarter and again today announced in the US, the biggest banks announcing very, very significant additions to their loan loss reserves. That's for institutions that are and have been profitable in recent years. That's manageable and leaves them stable. But when you have an entire industry, particularly in Europe, where profitability has been more challenged, the ability to follow suit and address that potential balance sheet impairment is another potential pitfall that's out there that we need to remain focused on. So overall, if you look at the actions, as Tom you outlined, that have been taken by central banks led by the Fed, but many of them around the globe, this has introduced a big question relating to what are the moral hazard implications of this type of activity, where the Fed is essentially stepping in and bailing out all market participants by providing the kind of liquidity and now increasingly credit puts that are underwriting the stability of financial markets. It's produced extraordinary responses in terms of recovery in spreads, recovery in equity valuations, and the implication of that is, will investors be dependent upon the assumption or presumption that that kind of support will be there in future, and what does that mean from the point of view of the central banking authorities, whose job it is to avoid the creation of irrational exuberance in these markets. So I think given all of these factors, and I didn't touch much on mortgages, Tom, because you did, but I think another area to be aware of is the fact that non-bank mortgage origination has become the dominant provider of mortgage liquidity, certainly in the United States, where banks make up approximately 20% of mortgage origination now, relative to 80% pre-global financial crisis. When you add all of these factors together, I think you can expect to see a raft of new regulations being proposed in the aftermath of the COVID crisis, which seek to tackle some of the issues I've addressed. Non-bank actors who weren't captured in the last reforms this issue of moral hazard and how to address it. The fact of mismatch in money market and mutual funds, again, and the fact that the prior reforms were not sufficient to avoid having to bail those out again. Some addressing of the inherent risk in the insurance sector from a systemic stability point of view. So I think all of these things are going to be important to watch in the months to come as the rest of this story plays out. And then just turning for a couple of minutes to the topic of what does this all mean for technology and innovation? I think probably the place to start there is that we probably just experienced in a few short months, 3 or 4 months since the beginning of this crisis, probably 2 decades worth of evolution of digital behaviors. So a massive decline in use of in-person credit cards, a massive increase in e-commerce, a massive decline in branch visits and on-site visits. And if it wasn't already obvious to financial service providers that to be relevant and to understand your customer, you need to be digitally engaged with those customers, it's now abundantly clear. We're essentially walking into a credit crisis, but flying blind because of the fact that the many government programs that have been put in place, payment holidays, unemployment benefits, all of these supports that will at some point run out. It's very hard for financial institutions to know whether those customers that are behind or delinquent on payments will fundamentally remain that way, or whether they will be able to resume when circumstances mitigate their situation. The need for digital engagement to understand your customers' purchasing behavior and other factors is increasingly becoming clear. So, from the point of view of evolution of financial institutions and non-bank players, those that have a digital strategy will be among the winners, and those that do not will definitely suffer. Having said that, many of the non-bank actors who were gaining market share prior to this crisis have done so without demonstrating real profitability. So I think given the restrictions in funding and other challenges that will occur as a result of all of this, you're likely to see some of those fail and others of those get absorbed in partnership or through outright acquisition with existing financial institutions that have an incumbent customer base that they want to strengthen the moat around. So I think you'll see a lot of consolidation, a lot of M&A activity, some failures, and again, a space that will be very interesting to watch in the months to come. I could go on for a long time, but I won't because I've run out of time, and I'll pass it over to Gay.
Thank you. Oh, thank you, Blythe, I always love listening to Blythe's insightful comments, and they are so spot on always. And thank you, Tom, for setting the stage. And good morning, good afternoon, good evening to wherever you are and whoever's joining us today. I'm pleased to offer my perspective on this, which is really derived from my current board roles during this COVID-19 pandemic, which we all have agreed is a global challenge in lots of different ways and threatens the societies in which we all operate. I used to think, this is a quote from Alice Through the Looking Glass. It says, quote, "Believe 6 impossible things before breakfast." I thought that was one of the funniest things ever written until this year. I've come to realize basically and understand it's a statement of simple fact for this corona addled age. I really can't believe how confused, conflicted, unfocused, and distracted the various threads of society are becoming. So while the virus has been lashing its way around the globe, the pandemic has become the defining event of the decade, which has brought a whole series of unexpected issues, not just in economic numbers, but in bizarre behaviors. So let me add to what's already been said. I'll touch a little bit on the natural resources sector, but mostly the resulting trends we've seen in financial crime risks. The natural resources industry is cyclical in nature, and Blythe commented on this. The decline in demand for oil due to COVID-19, which is due to travel bans, social restrictions, factory closures, combined with the pricing and production disputes within OPEC in Q1, has resulted in oversupply and depressed prices. I mean, they have bounced back, but we were all-time lows, or almost all-time lows. But never before really has the industry seen a shock to supply coupled with an unprecedented drop in demand in a pandemic. There's a cyclical nature. Usually they get through it, but this is unusual. Major production cuts occurred in May, which resulted in some improvement in the price, but we've not yet seen a full recovery in prices, and overall demand continues to be impacted. But now people are reversing their shut-ins, so production is starting to commence again. Now, one of the issues that we've seen with this key stress points are the joint ventures that occur between states and independent oil and mining companies. Governments have made huge commitments to their electorates and rely heavily on these proceeds to satisfy them. So whether it's oil or whether it's other natural resources are the key contributor to their GDP, these stresses are now magnified. So if the demand loss becomes permanent, falling oil revenues may result in continued political destabilization, renegotiation of many contracts, possibly even delays or cancellations of projects, and also result in cost cutting and job losses. And some production may no longer be viable. So the effect is potential an increase of problems, and that is a financial crime increases risks through the opportunity for financial crimes such as corruption in contract negotiations or in privatizations, as well as making communities extremely more vulnerable through personal financial stresses. And we've already seen security breaches linked to the effect of low energy prices. There's also the potential for trade and credit fraud, being lending risk, as distressed companies may have resorted already to fraudulent behaviors, such as false trades, non-existent trades, phantom shipments, and all to generate revenue or access credit lines, but not real. Now, the mining sector does not have quite the same supply pressures as oil and gas. Prices for some of these, whether it's irons remain robust, aluminum dropped like a rock's come back, copper slightly come back, but they've helped because this is what's helped isolate the major mining companies from the worsening cash flows. And gold has done well, benefited from the wider economic conditions. I mean, COVID has had a limited effect in this industry, except for the human impact and the limited lack of demand of material. Now, what we've seen, and we always see this, but it's a big increase, is cyber attacks. The oil, gas, and mining companies have all been vulnerable to financial crime threats, such as cyber attacks in the past, and frauds on companies and their staff. I mean, before COVID, you'd say maybe 70% of companies had experienced security compromises, but now attackers have adapted new methods towards COVID-19 themes. I mean, an example that happened right away on March 31st, attackers had conducted a campaign to extract sensitive communications and data from energy companies. They focused particularly on companies from Malaysia, the US, Oman, Iran, South Africa. What happened is they sent emails to about 150 oil and gas companies, inviting recipients to submit bids for equipment and materials for a project on behalf of a well-known company called Borealis. The emails mimicked the Egyptian state-owned oil company called P.R.I.M.E, Engineering for Petroleum and Process Industries, and referred to a real project called the Rosetta Sharing Facilities Project, which is linked with P.R.I.M.E and Borealis. Now, as we know, recipient opens the attachments, which represented as bidding conditions, forms, and a request for proposal. And the spyware was installed, which could extract sensitive information. The content of the email and the focus indicated a target attack, once again, on the oil and gas sector. Now, a second attack occurred using the same spyware, like on the 12th of April. And there's been more since, but this just gives you an idea. The recipients were requested to send an estimated port disbursement account for a specific vessel, which was actually an actual ship due to arrive at its destination 2 days later. And as I said, there are just much more stories like this. So we've had to increase you're watching over this sort of thing. So the discussion of the financial crime trends in the natural resources sector under COVID-19 should be seen against the backdrop of the financial crime risk profile of the sector more broadly. It is vulnerable to corruption and reflects large profits associated with this industry. Oil and fuel theft are persistent, and each year it's estimated that the U.S. about 133 billion in U.S. dollars are stolen, adulterated, or defrauded from petroleum companies, which results in losses to government revenues. Now, the proceeds provide a source of income for organized crime, non-state actors, and terrorist groups. There are links with trafficking and smugglers on drugs, human trafficking, illegal wildlife, and in some countries, terrorist organizations, militias, and armed gangs use natural resources as a source of income. Now, with this economic downturn and the humanity crisis, it correlates with increases in bribery and corruption. And investigations into government stimulus for previous responses have identified improper fund flows, whether it was the Ebola of 2014-16, whether it was the Hurricane Maria in 2017, even the Venice flooding, 2019, basically had improper fund flows. It's because, we've talked about this, the government stimulus packages or equivalent support provided through private funding is being dedicated to COVID-19 response efforts. So corrupt officials or other individuals may misappropriate these funds and then launder them back through the financial system. We saw this recently in Zimbabwe. We've seen it also, there was a government relief fund in Germany of 31 to 100 million euros were lost between mid-March and just early April. To tell you how soon they jumped on the bandwagon. And that was they had copies of an official website was established by the German North Rhine-Westphalia province. And it was made up by cyber criminals. And these criminals filed requests for government aid on behalf of real people, but diverted the funds from the legitimate recipients. So it was an estimated 3,500, 4,000 fraudulent requests were made. And it was up to probably about 100 million in euros. Up to 1 in 10 applications for UK government business grants are estimated to be fraudulent. And the business in the UK, they've been, targeted by a business offering to assist in obtaining a government grant for a fee. That's fraudulent. So similarly, though, we also have procurement or construction projects, such as the community medical facilities, provide an opportunity for corrupt diversion of funds or equipment. Improper payments may also be made to facilitate trade across closed borders just to win or retain business. So we also have an issue when you've got employee risks. Companies start focusing their shifts towards revenues and performance targets because tough times. So attention is diverted away from the employee conduct, creating an opportunity for bribe taking or bribe paying. And where employees experience financial difficulty as a result of COVID-19 due to scarcity or increased cost of necessities or reduction in family income due to under or unemployment, they may become more vulnerable to becoming involved in bribery or other financial crimes. They also may be more vulnerable to being recruited as money mules to launder proceeds of fraud or other crimes. So, and then we have the increase in remote working, which increases reliance on availability and security of technology infrastructure. And this creates risk, including leakage of sensitive information, where less secure or insecure methods are used, vulnerability to disruption attacks which deny access to resources, or demand for ransom payments as a condition of ending an attractive or restoring access or data. Now, I mentioned the cyber attack earlier, and as we know, cyber attacks can be perpetrated through methods such as inducing a recipient to click on a link called clickbait, or sometimes just through social engineering. And this clickbait downloads malicious software to steal data or disrupt service. And attackers have adapted now their methods to incorporate COVID-19 themes, such as emails purported to come from the HR department, advising of changes, even your health alerts, even from your Department of Health, or lists of infected people in specific area. So that we have seen an increasing amount in that situation. Then we also have business mail, email compromise. People are trying to trick staff into diverting or rerouting funds into accounts controlled by criminals. Fraudsters impersonate a senior person or supplier to request action from staff to update bank details. Nothing new, but we're seeing more of it. And when you're working from home, it's even more difficult. Recently, we'd seen a European pharmaceutical company who was defrauded of about 7 million plus more after the company transferred funds to a local bank in Singapore. The items were surgical face masks and sanitizers that they were trying to acquire, and they were never delivered. And then the supplier becomes uncontactable. A Singaporean national was arrested for his alleged involvement, and it was reported that part of the paid funds were moved out of Singapore. But through what they call the Anti-Scams Center, which is a collaboration between Singapore Police Force, and several of the banks, some of it was recovered. Now, sitting on a bank board, we understand the financial institutions have a key role to play in identifying and intercepting the proceeds of crime being laundered through the financial system. However, banks have had to work with other partners. They can't do it on their own. So we found the most successful areas where we work with government, law enforcement, and other financial institutions. And our information sharing partnerships have formed the cornerstone of financial crime fight in efforts over many years. And that's played a very significant role at this critical time. And the UK has set up something called Otello, Project Otello, which is the UK government's financial crime response to COVID-19. It's a fusion cell comprising banks, law enforcement, representatives from financial information sharing partnerships, and payment providers, as well as telecommunications insurance entities. So that they have working hard to try to stop all this crime that's happening, but it's huge and vast. And sadly, in my opinion, having been a former regulator, regulators and supervisors remain too focused on just the technical compliance, meaning rules and regulation, rather than on effective outcomes. But hopefully, the experience of COVID-19 can provide a driver for reform. It can strengthen the ability of financial crime fighting community to respond, and not just during this pandemic, to ongoing criminal activity as well. So I'll stop there so we have a few times for questions. But as Blythe said, we could just keep talking forever. So much is going on. So thank you.
Thank you to our speakers. And again, we are open for questions. We have our first question relates to a topic which actually I was going to ask Blythe to comment on, which relates to blockchain and Bitcoin, which we really didn't have a chance really to speak to. But the question is, I have a quick question regarding AML and the cryptocurrency industry in the EU. Will the pandemic affect the implementation of 6 AMLD in the EU? Will the deadline for implementation be postponed? Do you have any thoughts on that, Blythe?
I have no detailed knowledge of the status of that. If you ask based on opinion as opposed to sort of knowledge, I would say I think it's very unlikely that the pandemic will materially delay that, because I think, as Gay's comments have just outlined, the potential for AML and other illegal activities and financial crime is only increasing in this environment, and regulators are absolutely aware of that. So I would be very surprised if the pandemic were to result in a material delay.
I'll just jump in. I mean, it's something we are implementing. I chair the Financial Crime Committee at Standard Chartered. So the implementation of all this, we are not stopping. We don't think they will delay it. It is a huge issue, and we should have the systems in place to try to detect as much as we possibly can. I agree. I don't think they'll delay this.
So since we're still on financial crimes, Gay, and as you said, you chair the board committee on financial crimes at Standard Chartered. What advice are you giving to your clients?
Well, it's a good question. We are telling them to be vigilant for sure. Watching payment flows, which is a big issue. we're talking about, since we work in many 70 different countries or so, we're talking about these private partnership, issues where you as a bank can't do everything. But what you can do is work in conjunction with your law enforcement agencies. And the U.S. has allowed us through a particular ruling, which I can't remember off the top of my head, to allow us to share this kind of data. And I think that's the sort of thing we're telling in in other countries, work more with it. We've seen a big pickup, sadly, in Africa for wildlife trafficking. In the wildlife, because there's been less people going down on safari. So poachers are going in, but it's not just poachers. They're then selling off to gangs who actually do other things. They get into drugs, they get into sex trafficking. It's not just one element that they're looking at. So I think with our clients, we're just saying be diligent on your payment flows, know your customer. I think Blythe talked about that's the one thing we've got to understand these days, whether you're renegotiating their loans, but who's basically sending the funds in and why. And so asking a lot of questions. But we also know we have people under a lot of stress because they're working from home. So it's not as easy to detect this, the follow up.
So another question for both our panelists. Given that we've seen this massive central bank intervention, how concerned are you about central bank balance sheets and their ability to continue to support the markets as they have?
Well, I mean, if anybody that says they're not concerned to that would be taking, quite a bet. But I do think that broadly speaking, the actions taken by central banks have been the correct ones, notwithstanding the fact that it has resulted in an extraordinary expansion in central bank balance sheets. And the reason why they're the correct ones is that what they're seeking to compensate for is a significant amount of slack in the real economy that is caused by, an extraordinary supply and demand shock. And in that context, the normal consequences of printing money, quantitative easing, and some of the other undertakings, in normal circumstances, when you don't have that slack, you worry about inflationary pressures and all of the adverse consequences of that. But in this context, you don't have that immediate risk, and so the longer term question as to how this gets unwound is obviously a challenging one, and I think ultimately that's going to boil down to how long we have to unwind. What period of time does that unwinding take? A dramatic reduction or reversal will have much more severe consequences than something that's tapered off somewhat gradually. And that will depend, unfortunately, as much on politics as it does on economics and economic theory. And also on behaviors and whether the introduction of artificial incentives for all the right reasons produces the wrong behaviors in terms of the way that both individuals and entities operate. And that, one of those issues is obviously the moral hazard one I mentioned earlier. There's an enormous amount of risk associated with unwinding this situation, unprecedented levels of risk. So I wouldn't take my comments as being poo-pooing that risk. I'm simply acknowledging that I think that the central bankers of the world didn't have much choice, and that in the short term, there's sufficient slack capacity to absorb or to require those actions.
Yay, any thoughts?
Oh, I can't disagree with anything that's been said. I think unwinding this will be the most complicated thing for all of us. We don't know what the shape of we keep talking about, is it a V? Is it a swoosh? Is it a W? I mean, this is not going away. As we just saw, Hong Kong had some sick cases, 52 cases yesterday, and they effectively closed it back down, and they took great pride. And now they have everybody working from home again. We're going to, until we close this off, this is not going to allow the economy back, basically come back to any kind of normality. that we will have seen in the past. So I am worried about future generations. How are they going to pay off this debt? When you look at the amount of debt that's borrowed within 1 month versus an entire year in the past, it's enormous. Or versus GDP is very disconcerting. And I don't think anybody has the answer quite yet.
A question for Blythe. Blythe mentioned that moral hazard is being the result of a raft of regulation that has come into the markets to mitigate the risk for the negative impacts of the pandemic. So what kind of risk do you see firms, entities, et cetera, taking if they perceive their costs are now covered? I'm not entirely clear on that question, but I think you perhaps...
Yeah, no, I'm happy to give it a shot.
Answer the issue.
I think the issue is that if you create the impression, real or otherwise, of a put that's underwritten, that is underwriting valuations in the market, that will result in what's been coined in the past as irrational exuberance, and in fact, there are many people that believe that one of the contributing factors to the global financial crisis, of which, of course, there were many, but one of the contributing factors was the housing policy stance and the monetary policy stance of in the U.S. In the run-up, in the years running up to that crisis, where essentially what became known as a put under the equity markets encouraged irrational risk-taking. When you have irrational risk-taking that is financed, if you will, or protected by a government actor, then the normal constraints on risk-taking behavior and the normal disciplines, market disciplines that punish poor performance and poor risk-taking no longer come into play, and that is what leads to essentially bubbles, and bubbles lead to bursts. And so what the concern is that these actions will lead to inflationary expectations that ultimately are not realistic. When that realization sinks in, then you will have a correction that far exceeds what the correction in a more natural process would have been. And when corrections happen at great speed, great damage occurs. That's what occurred in 2008. That was exactly what happened. When that bubble burst, with expectations around slack monetary policy and ever increasing housing prices, when everybody finally realized that was not going to continue indefinitely in the face of over-leveraged balance sheets, the rest was history. And so that is the concern. Are we recreating similar incentives to those that existed in the run-up to the global financial crisis? And there have been other periods in history where this has also been true, but that one's probably the most obvious and recent example.
So we have a couple of additional questions, but we're running out of time here. There's one additional question on cryptocurrencies, which is, what is the view of the FCA and the EU regulators on reporting from stakeholders that are mainly based on AI, which I'm assuming is artificial intelligence? Okay, Blythe, any comments?
I'm not close to the cryptocurrency on terms of what's happening. I mean, I believe, other than, I look at the financial crime side, and some of the, some entities has been proven in the past that, many of the proceeds going through them were bad financial crime monies. Doesn't mean everything in the virtual currency money, those cryptocurrencies is a bad thing. I don't know what's going to come out of Europe on that issue, but I'm not really that close to it. Obviously, the UK, the Bank of England's come out with a paper, was it last year or 18 months ago, on some of these issues. They've been kind of reluctant to basically do much in it. But I turn that over to Blythe in her fintech world, maybe.
Unfortunately, I'm not sure that I entirely understand the question, and it's rather hard to get a clarification. I think when it's written in writing, I'm not sure if we can do that. But I agree with everything that Gay just said, but I'm not sure that I can add anything. So I'm not really sure what's meant by reporting from stakeholders that's mainly based on AI. And I apologize if I'm being a bit slow, but.
So with that, let us end our session today. And again, we have some additional questions which we will do our best to respond to in writing. First of all, I want to thank both Blythe and Gay, and I should add that I did not mention when I talked about my bio that I am also a P.R.I.M.E expert, and I also happen to be a member of their advisory board. So I've been very involved with the organization, and it's a wonderful organization now since pretty much day one. This is one of a series of primetime virtual events. Details of further events can be found on the virtual on the Prime Finance website. The next session on the new UK Insolvency and Governance Act 2020 sounds interesting. Will take place on July 27th with speakers Jennifer Marshall, Insolvency and Restructuring Partner at Allen Overy, Joanna Perkins, Chief Executive of the Financial Markets Law Committee, and Philip Wood. Registration is now open, and you can see the link in the chat box. Primetime is also then taking a break over the summer, and will return in the fall with a number of sessions on insolvency and restructuring, technology, and sustainable finance, which should be incredibly interesting. I want to thank DWA Financial Technologies for their sponsorship, and Lexis and Milex for their support. If you're interested in sponsoring a future event, please get in touch. I should, last but not least, talk about Friends of Prime. Prime Finance is a not-for-profit, and certainly we need donations to support our work. If you would like to make a donation or to find out more, please contact the Secretariat using the details showing in the chat box. And with that, I want to thank everybody, and good day.